We're just about a minute and a half into today's trading session, and joining me now is Michelle Schneider, who is the partner and managing director over at Market Gauge and managing director of trading research and education over at Market Gauge. Michelle, always a pleasure to have you here. Thanks so much for joining us. Historically, Q3 sees some lackluster activity. However, the second half of the year tends to be good overall for the market. So which sectors should investors keep an eye on?
Well, right now, the sector that's been lagging the most has been the transportation sector and also the banking sector, particularly the regional banks. And there's some real reasons for that. The biggest concern would be, of course, that they're really relaying something that the market hasn't seen yet, which is that growth will at some point stop when we get through the whole back to work, back to school situation that we've been in that has created a lot of the euphoria. The yields, which have been down, may be projected to go up at some point. And of course, this whole sticking inflation narrative, which is still very much alive and well, that's all what we're seeing reflected here. So I have my eyes there because it's the divergence between the S&P 500, the NASDAQ, all which went to new highs, the Russell 2000, which hasn't quite gotten there yet, and then this transportation, which actually is in a caution phase. And if we cannot really start doing some catch-up here, it might be, and we don't know how long, but it might be projecting some level of warning overall in the market.
So the S&P 500 breaking a fifth consecutive record close, and it's natural to think, do we expect to see some type of pullback in the near future, given all of the new record highs that we've seen for the S&P 500, even the NASDAQ, some new record highs that we've seen over the course of this week?
Well, of course it's possible, but right now the momentum is on the side of the market. So we have seen a situation before, whether it was going back to 2018 or even before that, where semiconductors and the whole mega cap growth areas can lead the market up for a while without the industrials, without the transportation really participating. And of course, the other side of that would be retail. That also has to keep up. And that's doing so far so good. And seasonally, of course, we're coming into a strong season. So we may not see that kind of correction that people are expecting, possibly until we get through this next earnings season. We could see some really good earnings coming up. And then as we get into the fall, that's when things might get a little bit more sobering.
Let's talk about the jobs part of the equation here, because we've seen jobless claims come out this morning, a new pandemic low, but at the same time still well above where we were at pre-pandemic, of course. When we think about going forward from here with the June jobs report set to come out tomorrow morning, where do you see the future of the employment situation? And going into Q3, what does any success on the employment and the labor force front hinge on right now?
Well, the interesting statistic, besides the fact that we saw a good jobless claims number, was that 3.5 million people are still collecting unemployment benefits. And as we know, in September, all those benefits are set to go away. So I do believe that now that we're going through, we're going to see the numbers. They're expecting about a 5.7%, which is a slight improvement to last time, which was 5.8%. And I think that's the direction we're going to go, at least for the next couple months, where we'll see these improvements, particularly as people have to go back to work when their jobless benefits go away. But I'm concerned about what happens after that. And this is the question that keeps nagging at me, is where is the job growth going to come from once we've gone back from the pandemic? And that's where infrastructure package comes possibly to save the day. I don't know if that may be strong, but I'm really kind of skeptical about this job growth as we head into the fall and towards the winter and at the end of 2021. As it is right now, one of the reasons, we're seeing so much of a supply chain disruption also is in the trucking business. I read that a lot of the reasons why gas is so high is because there are not enough truck drivers to deliver the gas. And so this is really a pattern that we could see going forward in terms of the whole labor market. Plus, there's this, we talked about the inflation thing, but let's put that back in with tangible. yesterday, General Mills announced that they're going to have to raise their prices because food commodities have gotten so expensive. And I'm sure you've noticed, like if you just look at the price of sugar from a year ago, it's doubled in price. Oil, of course, and gas going up. So if General Mills is some kind of a metaphor for what could happen, not only will they have to raise prices to consumers, which of course will feel the pinch, which would affect their bottom line, but also it might mean that they have to cut their staff as much as possible. And so all of this to me just keeps smacking in my brain that we could be heading more for a stagflation environment, which would not be fun.
Yeah.
It's very difficult for the Fed to deal with, but something that we should be at least aware of.
Yeah, you mentioned a moment ago energy, and particularly I've been keeping an eye on the gap down that we saw earlier this week, and then followed by today's early gap up by about 2% for the S&P 500 energy sector. And so as you kind of look across your own research and what you're discussing with your clients, where are the opportunities? Where are you charting kind of the safest spots within the market right now?
Well, safe is definitely an interesting word because I've often asked, what is safe? Bonds certainly may not be safe. The dollar may not be safe. Equities, particularly growth stocks, may not be safe. Value, which went down, how safe is that? Really, to me, it really gets down to what's going to happen here. I think, interestingly enough, with not only what's happening in the energy market, but the fact that gold and silver, or precious metals, are so undervalued. I look at it not only as an opportunity potentially, but I look at it as tremendous information. Because in 1980, gold relative to the Dow was about a 1-to-1 ratio. And here we are, 40 years later, and the Dow is trading at 20 times the valuation to gold. So what does that mean? Either gold is going to catch up because inflation is real, and we can see gold at, say, 15,000, or the Dow is about to half to get more relative to the gold. So that's where I have really big eyes on that. And I also have really big eyes here on the junk bonds. We've talked about this before, Brad.
Yeah.
Because the junk bonds have been the Fed folly, and they made a new yearly high just yesterday. They've cleared a major moving average, but they did exactly that in January of 2020. Then they gapped lower, and they never came back for a long time, at least for 3 months.
Right.
So this is, I don't know what's safe right now, other than we're still buying equities. There's still obviously some good plays on the table, but we're ready to be nimble if we have to be.
All right, Michelle Schneider, excellent research as always, and thanks so much for sharing some of that with us today. Partner and Managing Director over of Trading, Research, and Education over at Market Gauge. Everyone, let's get you caught up on some of the other big stories that we're following.